Looking for strategies to help you protect your portfolio in these uncertain times? Visit robblack.com. robblack.com, powered by EP Wealth.
I record this a little bit before the market closes on Friday, but the S&P 500 and the NASDAQ are set to close at record highs. The standing of the major indices is mixed, yet the tone of the session is positive. That's because key leadership groups are leading and because talk is swirling that delegations from Iran and the U.S. could be meeting this weekend in Pakistan. President Trump reportedly said on CNN that he will be sending Steve Witkoff and Jared Kushner to Pakistan for talks with Iran, and that Vice President Vance will be on standby for a possible visit. Oil, flirting with $98, fell to about $94. Wall Street likes that. Intel up 20%, better than expected earnings report and outlook. I'll hit on that in just a minute. The good news for that is it's filtered into the whole semiconductor industry, and that's been instrumental in driving the information technology sector up 2.3% today, and the Philadelphia Semiconductor Index up 4.5%. There have been some underperformers like Apple. It just looks like it's a holdout, and when the AI trade does well, money seems to come out of Apple. And when the AI trade does poorly, money seems to go into Apple. Meta's up over 3%, Amazon's up 2.7%, Alphabet up 1.4%, Microsoft up about 1%. They're doing the heavy lifting on the Vanguard Mega Cap Growth ETF. It's up about 1.5%. Of note, tech, communication services, and consumer discretionary are the leaders. There's some laggards in healthcare down 1.5%, and obviously energy with oil prices lower. But Eli Lilly is down 3.8%. They seem to be getting pinched on weaker than expected volumes of a new drug sale. That's GLP-1 for pill version versus the shot version. So the NASDAQ is riding its best 4-week stretch since last May. It's set to rise for that 4th week in a row. The tech-heavy index is on track to cap off a 17% run in that stretch. It's not new for the AI trade to define markets, but the current stretch borders on ridiculous. So the SOX is doing well because of AI. The iShares Semiconductor ETF, ticker symbol is SOXX. I should explain that. It's risen for 17 straight days. By the end of today, it'll be 18 straight days. It's the longest uninterrupted win streak for any U.S. semiconductor benchmark since at least 1993. The prior record was 15 days. So it's clear, like Intel's outpacing its fundamentals. It has a very lofty PE now. And I'll talk about Intel in just a second. But before we go there, I want to talk about the big picture. The S&P 500's gained 12% since March 30th. The NASDAQ's up 17%. But when you strip away the chip leaders, that rally thins out quickly. So the market, the S&P 500 market, its big move is all about the AI trade right now. We want to see it broaden out. And we're going to see it broaden out because today there was some news that the Department of Justice is ending the investigation to Fed Chairman Jerome Powell, paving the way for the Kevin Warsh confirmation. Warsh is expected to cut interest rates almost immediately when he comes into office. But Warsh wasn't going to be appointed until the investigation into Fed Chairman Jerome Powell ended, as President Trump was feuding with Senator Tom Tillis out of North Carolina, a Republican, that said he wasn't going to move to a vote until that case got dropped. Consumer sentiment is rebounding slightly in the wake of the ceasefire, but pessimism abounds in the United States. So this is something that's in our head. Oil is still very expensive. It has been now for almost 2 months. And when I say expensive, compared to historically. And that's going to lead towards, when does the strait reopen? When do we get oil back online? And by back online, there's been significant damage to oil production. Gulf crude oil production is down by 57% or 15 million barrels a day. Goldman Sachs estimated those numbers. Production is likely to mostly recover within a few months of reopening, assuming there's no fresh strikes on oil assets and there's a full and safe reopening of the Strait of Hormuz in the coming months. There's some questions if there's mines being laid or have been laid that are going to need to be cleared out, and that could take months. So back to Intel. Intel shares are having the best day in nearly 30 years, up 20%. I didn't see that coming. It's the biggest rally for Intel since October 29th, 1987, when they soared 26%. But that was part of a smaller tech stock back then that came up as the Federal Reserve pushed interest rates down following the stock market crash in 1987 on Black Friday. Intel's surge today is all about a turnaround, but it's pushed key metrics like price to earnings multiples up to 100. Now, again, the current quarter got that back down to like the mid 60s and 70s, depending on what numbers you're looking at. That's incredibly high. That's too high. That's, higher than Nvidia's PE of 24. It's at 70. And they're not Nvidia, but Lip Bhutan has already pulled off one of the most remarkable turnarounds in the history of corporate America. Can he put 3 more quarters in a row like this together, and then it doesn't look so expensive? There is competition in AI for CPUs, processors that act like the brains of servers, which sit inside the head node of server racks. NVIDIA's GPUs and AMD gaining momentum for the x86 CPUs for AI. NVIDIA is doing some workarounds to get into these machines, but with a different flavor, if you will. NVIDIA is moving some CPU racks from Intel to Vera, Trainium, moving head node from Intel to ARM. Both TPU and Trainium are moving host nodes from x86 to ARM. So this isn't going to go terribly smoothly for Intel, unless it goes terribly smoothly for them. But there's challenges is what I'm trying to get at. HSBC says $100 price target on Intel. They think the market's been underestimating Intel's CPU average selling price upside, as well as its ability to reallocate its own foundry capacity to unlock further CPU unit growth, considering a CPU shortage environment that we expect to persist until 2027. Now, Bernstein saying it's a $65 stock. So we've seen a $100 price target. Now we see a $65. And Bernstein saying server strength seems demonstrably real. Client seems to be holding up for now. Commentary around 18A and 14A was positive. There remains hope for forthcoming packaging announcements. JP Morgan has the lowest number on the street at $45 for price target on Intel. They say earnings per share quality issues, second half gross margin headwinds, structural operating expenses are starting to creep, and a foundry break-even timeline that's likely to push beyond 2027 and keep us as ultimately underwhelmed. Meta signed a deal to use Amazon's Graviton chips this morning. Maybe it was last night, but it was reported this morning. They're going to deploy tens of millions of Amazon Web Services Graviton CPU cores to power the so-called agentic AI systems, tools that can reason, plan, and act on their own. The deal underscores a broader shift in AI infrastructure as companies move beyond NVIDIA's GPUs and use different chips for different tasks. AMD stock jumped to a record high today on an upgrade. So they're up 14%. Intel was up over 20%. What's going on in this world? Tesla has started Cybercab production. You could hit the X account, formerly Twitter, and you'll see some steering wheel-less Cybercabs starting to roll off the Gigafactory. It's a gold two-seater. This is all about the future of Tesla, fundamentally based on large-scale autonomous cars and large-scale and large volume, vast numbers of autonomous humanoid robots. That's what they're promising. I've got a good show for you today. I'm going to talk about the power of mortgages and why I never prepay mine. I'm going to go over my financial plan of what I've put in place using services of wealth advisors. And I'm going to talk about why you need to have patience with the AI revolution to create productivity gains, much like computers and much like electricity. It takes patience, productivity gains that can help with our deficit, that can help with our aging population. There's a lot of positives. Stay tuned. I got a good show for you. Don't forget, I have a seminar coming up, as well as a Pints and Portfolio. The Pints and Portfolio is next month. You can learn more about these events at robblackshow.com. That's robblackshow.com.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth, even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
Part of my research is reading white papers. I recently stumbled upon a piece by Vanguard Research called AI Demographics and the U.S. Economy, Quantifying the Coming Tug of War. This is what I got out of it. I want to build a framework. The most effective way of doing this is looking at some of the past technologies that were disruptors, especially in how prior technological revolutions actually translated into economic growth and investor returns. Breakthrough technologies don't automatically create broad prosperity or market gains. Companies that apply them to. It's going to come up again and again. Companies that apply the technology doesn't immediately lead to productivity. One of the first technologies in this paper was electricity. It began spreading across the United States in the late 1800s. The critical fact was productivity didn't surge immediately. It took decades for businesses to reorganize around it. Factories initially just swapped steam power for electric motors. Same layout, same inefficiencies. The real gains came later when firms redesigned workflows entirely. Two good examples of this were Ford Motor and General Motors. Ford used electricity to power the moving assembly line, dramatically increasing output and lowering costs. GM leveraged electrification to scale flexible manufacturing and multi-brand production. They were both huge winners in the stock market, created a ton of wealth over the next 30 plus years. The winners weren't the inventors of electricity. They were the ones who applied it. Another good example of this is the computer revolution. If you want to understand what's happening with AI today, the best parallel, it's history. Specifically the computer revolution. Because just like AI, computers didn't immediately change the economy. They changed it slowly and unevenly. And then all at once in the 90s. Computers began entering businesses in the 1960s and 1970s. By the 1980s, corporations were spending heavily on IT, mainframes, databases, early software systems. Productivity in computers didn't show up in the data. In this early period, they became known as the productivity paradox, famously captured by economist Robert Solow, where you can see the computer age everywhere, but in the productivity stats, not. Companies were digitizing old processes. They weren't reinventing them. Workers had computers, but workflows didn't change. Technology was layered on top of inefficiency. So when you layer technology on top of inefficiency, it's not going to be a winner. Now, again, that's where we are right now with AI. And a lot of people saying, I don't get it. We don't have a killer application. Be patient. It's coming. So the real gains for computers came in the 1990s and early 2000s. Not because computers got better, but they did. The 8086 became the 286, became the 386, became the 486, became the Pentium. But ultimately, business is finally reorganized around them. Let me give you some examples. Walmart used data systems and logistics software to create one of the most efficient supply chains in history. That equaled lower cost, faster inventory turnover, massive scale advantage. Dell Technologies built a direct-to-consumer model using computers and real-time inventory, which ultimately created negative working capital, faster production cycles. Microsoft standardized software across enterprises, becoming the backbone of global business productivity. They weren't just tech adopters, they were business model transformers. This is what you're going to look for in AI on the next step. Legacies in the computer age that didn't adapt, like Eastman Kodak, they invented digital photography, but they failed to pivot its business model, ultimately destroyed by the very technology it helped create. Blockbuster Video didn't adapt to digital distribution and data-driven models, so they lost to more tech-enabled competitors who built around tech first, not reinventing what they did. Traditional retailers without logistics technology couldn't compete with data-driven inventory and pricing. So that's why Walmart and Target are so powerful. They use data. Walmart won because they started using data, and Kmart failed because they had smart people from Yale and Harvard. They didn't rely on a new system like computers. So by the late 1990s, computers brought productivity growth. Output per worker increased meaningfully. Corporate profits expanded. Wall Street exploded in the 1990s into the early 2000s because companies finally rewired supply chains, automated back office functions, used data for real-time decision-making. It took 20 to 30 years from when computers were invented in the 60s and 70s. The computer revolution created an enormous amount of wealth. It wasn't evenly distributed, though. Companies that did platforms like Microsoft and Intel, they became the foundation layers for the digital economy. The operational leaders were companies like Walmart and Dell. They lowered costs, they scaled faster, they crushed competitors. Then late stage computers, companies like Amazon, eBay, they emerged after infrastructure was built and captured massive value. The losers of the computer age were dot-com bubble companies. Late 1990s. Great ideas, terrible prices. Legacy companies that couldn't adapt to digital workflows. They saw margin compress and or disappear. And companies that just misplaced bets, investing in technology without a clear path to monetization, confusing usage with profitability. So the time lag is real when a new technology is adopted. It does not equal immediate productivity. That's what we want from AI. It could help with our aging society and our deficits if we increase our productivity. It takes years, often decades. Early winners will be the hardware, late winners will be software, platforms, and applications. Productivity comes from reorganization, not the technology itself, but how businesses change because of it. So we're likely in the 1985-1995 phase of AI, which had massive investment, limited broad productivity impact so far, concentrated winners, the Magnificent Seven, AI ETFs, the QQQs. The next phase is we're going to have to see companies redesigning their workflows, margins expanding quietly, and new winners will emerge outside of pure tech. How does value get distributed with AI? Right now, most of the economic value is accruing in the picks and shovels layer. The companies building the infrastructure. NVIDIA dominates high-end AI chips powering data centers. Microsoft is embedding AI into enterprise software ecosystems. Alphabet is integrating AI into search, cloud, and productivity. These companies are seeing explosive revenue growth tied towards AI demand, expanding margins, especially NVIDIA, premium valuations. The next wave of winners, and if history rhymes, will look more like AI appliers than AI builders. Think of companies like healthcare companies and hospitals who could use AI to reduce diagnostic costs and inflows of patients. Logistics firms will optimize routing and inventory. Financial firms will automate underwriting and compliance. This is very real. A modern Ford moment might not be a tech company. You could lose by overpaying for the obvious winners. Even great companies can deliver poor returns if bought too expensively. You could lose in AI if you confuse adoption with monetization. Just adding AI to a business model does not create durable margins. And you could lose if you miss the lag effect. Productivity gains may take years to show up in earnings. Markets can get ahead of reality and then correct sharply. So if we're in the early phases of AI, which we are, picks and shovels, what's going to happen in the near future is we're going to start seeing a shift to other parts of our economy, not the tech part, but the healthcare, the retail, the manufacturing, the transports. We'll start using AI to improve their business models and create better productivity margins and thus more profits. That should help the S&P 493. It should help Europe. It should help small caps and mid caps that aren't tech oriented. But it takes time. Be patient. Those are my thoughts on AI.
And just hope that it works.
Don't want to work forever? Check out the Retirement Planning Guide on robblack.com. That's robblack.com, powered by EP Wealth.
I often use the phrase wealth accumulation. From age 20 to 60, you're in the wealth accumulation phase. I've spent my life creating wealth for myself and my family and for my radio audience, my television audience. I've worked as a registered investment advisor, so I did it with clients. I shifted to the world of financial planning because I saw it wasn't just about creating wealth. There was something else there. I seen what works. Usually, time is the biggest benefactor for what works in investing. Stock picking is very difficult, so I like indexes and ETFs for most people, plus time, and then go out and live your life. I've seen what fails, like annuities, insurance products, bad research, jumping on a trend late. I've also seen what quietly destroys wealth over time. Like most people, I didn't really appreciate the power of comprehensive planning until I turned 50. And I looked down and I had a lot of wealth. And I had 2 boys, Cam and Zach, great kids. Had a wife, lovely. She does a great job parenting. We actually use a financial planner. Not in theory, not in textbooks, but in real life. Wealth accumulation becomes wealth management. I want to tell you about some of the things that I do. We have a strategy for income, taxes, legacy, risk, and opportunity. It's not just stock picking. We didn't start with complexity, and I met my wife late in life, in my 30s. I was a bit too busy working. Before private markets, trust, tax strategies, there's something that you're going to need as it's a foundation. It still matters. It's the basics. Saving aggressively, tracking your spending, building liquidity, eliminating bad debt. I eliminate all debt over 6%. Now, none of that's sexy, but it's essential. I've learned and reinforced through years of advising others. Financial planning doesn't begin with optimization. It begins with control. Knowing where your money goes is the first form of financial power. So for my family, and again, we started with me as a single man, and then I met a woman, and we became man and wife, and then we had kids. But with me, when I was solo, it was consistent savings. I started at age 18, $166 a month. So it would become $2,000, which was deductible on an individual retirement account. Roth IRAs didn't even exist then. First chance I got to a 401k, and it was offered to me, I took it because it was automating everything. It was consistent. I maxed out my retirement accounts early. They double every 7.2 years. I maintained a meaningful emergency reserve of 3 to 6 months in case I lost my job. I didn't want to have to sell my long-term investments. I've always avoided lifestyle creep to the point that it's a bit of a problem now. I have 8 figures in my net worth, and it'll soon be 9 figures if I live another 10, 20 years. That's insane. I never thought I'd get there. So I drive a 2016 truck. I plan to keep it till it dies, somewhere probably around another 10 years. I buy 2 pairs of jeans. I wear them consistently. I don't have a closet full of clothes. I don't have a closet full of shoes. I'm very Spartan. I buy big ticket purchases on Black Friday when they're 20 to 40% off. It sounds simple. It isn't easy, but it's necessary to really get grounded with consistency, maxing out your retirement accounts, emergency fund, and then avoiding lifestyle creep. So from saving to strategy, at some point the question changes. It's no longer, are we saving enough? It becomes, are we structuring this intelligently? That's why I have a financial planner in my 50s, because I created the wealth, had a big pot of it, but it wasn't structured terribly smart. Financial planners aren't stock pickers. They're architects. They look at asset allocation, what goes into taxable versus tax-deferred accounts. I still can't tell you. What goes into long-term capital gains planning? They look at diversification beyond public markets and risk exposure across the entire household balance sheet. This is where the do-it-yourselfers and the people who don't want to pay for financial services hit a wall. Because investing isn't just about returns. It's about after-tax, after-risk, after-life cycle outcomes. So investment management is just the entry point. And it's probably the toughest part because I think a lot of people can do ETFs on their own. People often think of financial planners managing their portfolios, and some people like it and some people don't. For probably 90% of my portfolio, I manage it myself. And for 10%, I let them manage it. Through the years, that'll become more on their side of the fence, less on my side. I have a diversified investment strategy. I have public equities for growth. You look for fixed income to give you stability and income in life. You use alternative investments for diversification, but the real value comes from how those pieces interact. A good planner will correlate risk, what falls together. They'll look at sequence of returns risk, especially near retirement, liquidity needs versus long-term growth, and tax drags on returns. This is where institutional thinking meets personal finance. Building income for my retirement before I retire is something I started doing in my 50s. One of the biggest mistakes I see is waiting too long to think about income. Accumulation is easy. Distribution is hard. I've worked with a planner for retirement income streams. I want to do it with stocks that pay dividends. So building income for retirement before your retirement is a really important thing. One of the biggest mistakes I see is people waiting too long to think about income. I think accumulation is the easy part and distribution is the hardest part. That's why I met a financial planner, Chad Burton. I was doing the easy stuff, outperforming the stock market. So my family works with a planner to set up the retirement income stream years in advance, matching it with my budget. When I quit or retire or get fired, I want to just turn on my dividends, and instead of buying back shares, I want them to pay me my same income so I don't have to go out and get another job. I could if I want to, but I don't have to. So a good financial planner will help you with withdrawal sequencing across account types. That's tough for me. I have, let's say, 10 accounts. Which ones do I sell first? Another thing that I have now that I didn't have in the past was a contingency plan for market downturns, because retirement isn't about having a number. It's about replacing a paycheck and doing it in a way that survives market volatility, inflation, and longevity risk. I've got a trust for my family set up with my financial planner through an estate planning attorney. With two boys who are 18 and 16, the conversation shifted from wealth building to legacy planning. Not in a morbid sense, but in a practical one. My family established a trust not because we expect the worst, but because we plan for it. The trust allows us to control how and when assets are distributed. For my kids, it's going to be at age 25, 35, and 45. So that when they're falling in love and needing a house, then starting a family at 35. And then at 45, start thinking about retirement. And I'm out at that point in time. So I want to protect them against immaturity or poor decisions, bad marriages. So the trust sets it up, again, to pay them at 25, 35, and 45. And if they get married and the person and my son gets divorced, they don't get the assets. My kids retain them. So planning becomes deeply personable. It's not just about returns when you hit your 50s and start heading towards retirement. It's about responsibility, especially with estate planning and a trust. So my financial planner is really good at tax efficiency. I am not. If you're not thinking about taxes, you're leaving money on the table. 2 years ago, I had a mid six-figure tax return that I owed. This year, it was about $100,000. Tax loss harvesting strategies, asset allocation optimization, Roth conversions in strategic years, capital gains timing, charitable giving structures. The goal isn't to avoid taxes. It's to control when and how you pay them. And over decades, that compounds dramatically. It's a huge return if you are tax efficient. It's the number one reason why I use a financial planner. Medicare and Social Security, these are decisions that matter a lot. I'm starting to get to the years of hypertension. I'm starting to get to the years of complications with my body. So Medicare and Social Security aren't just government programs. They're financial levers. When do you claim Social Security? What are your spousal strategies around it? My spouse doesn't work right now, so I'm going to have a bigger yield in what I get from Social Security. The taxation of benefits, Medicare enrollment timing is something I don't want to do it. Then there's the income thresholds that trigger surcharges, and you want to manage those as well. I've got a lot of Apple, Microsoft, and NVIDIA, so I'm managing my concentrated positions, selling off roughly 3% a year, generating option income that's over 6 figures. In large part, it's given me gradual diversification. The option overlays are giving me added income from the stocks that I already own, more than their dividends. And I've created a charitable trust so that I can do advanced planning. It's increasingly common because wealth often isn't built evenly. I have access to private markets like private credit, private equity, and private real estate. One of the biggest shifts in planning has been into that for me. It's not great for liquidity. You have to have a long time horizon. You have to do careful due diligence, but the income streams are less tied to market volatility. They give you access to growth before companies go public. It gives you diversification beyond traditional assets. I have a rental, a home for vacation, and I have a home that I live in. Real estate for me is an inflation hedge and gives me some tax advantages and a little bit of income generation. I understand cash flows, but tax efficiency and risk-adjusted returns are important as well. So having a financial planner come in and say, this is what your real estate's doing. This is what your insurance is doing. This is your estate plan. This is your tax efficiencies. This is what you want to do with Medicare and Social Security. You have enough income to retire. Go retire and have a good time. Don't worry about the markets because we got your income strategy. That's why I use a financial planner. And if you ever want to talk about it, I'll set up a Zoom call with you. Drop me an email, rob@robblack.com. That's rob@robblack.com. I'll talk financial planner with you. I'll tell you what I use and don't use.
The markets are more volatile than ever. Inflation, interest rates, global uncertainty. If you have $500,000 or more invested, ignoring it could cost you your future. At EP Wealth Management, they offer a free preliminary financial plan, a chance to identify potential risks in your portfolio before the next downturn hits. Get insights from Chad Burton, CFP, and Rob Black, trusted voices in financial planning and retirement strategies. They'll help you spot hidden risks, rebalance thoughtfully, and uncover opportunities to grow and protect your wealth even in turbulent times. Their goal? To help you feel more confident about your financial future during uncertain times. Don't wait for the markets to decide your future. Schedule your complimentary preliminary financial plan at robblackshow.com. That's robblackshow.com. EP Wealth Management. Plan smarter, live better, no matter what the markets do. Investments not FDIC insured. Past performance does not guarantee future results. Not an offer to sell or a solicitation to buy any security. Member FINRA SIPC.
I believe in wealth accumulation, and one area outside of stocks that I've accumulated wealth in is in real estate. Having been in this industry for 30 plus years, I see a lot of people make mistakes and wrong assumptions. Did you know that historically, in the last 30 years, the S&P 500 has outperformed real estate in total return, averaging 10% annually compared to 4 to 8% for residential real estate. 4% is the typical rate of return you should expect for real estate. But keep in mind, you should also expect about 2 to 3% in inflation. So its real rate of return's not that great. The S&P 500, by getting 10%, is able to get 6 to 8% better returns than inflation historically. Stocks provide superior liquidity and convenience, while real estate offers tangible leveraged income. The best choice depends on goals. S&P 500 wins for pure growth. Real estate wins for income and tax leverage. Plus, with stocks, you could get liquidity and convenience. They're easy to buy and sell with minimal maintenance. You get compounding power. Reinvested dividends in the S&P 500 index delivers better long-term performance without the effort of property management. With real estate, the best thing you get is leverage, a mortgage. I think that's a really powerful financial tool. Sometimes you get cash flow and tax benefits, but I see way too many people own $1 million home, rent it out, and they're only getting about 2% yield. You could do better. You got to look at your cash flow. One of the things I should talk about here is paying off your mortgage. 30 years ago, when I was still young, I was forming ideas and theories. One of the first financial influencers who ever got in my life actually happened in high school, about 40 years ago. And his name was Rick Edelman. He did a local cable show. He was a financial planner, and his talks, I recorded them on a VCR, video cassette recorder. He did a whole show on was reasons to carry a big, long mortgage. And it flew in the face of what my father taught me. It flew in the face of what you were probably taught as a kid. The word mortgage has death in it, mort. And there used to be mortgage books. My first couple mortgages, when I took out the loan from the bank, they would send me a 30 years times 12 months. They would send me a book that I would take the coupon out, write a check for that and send it in. And back in the 60s and 70s, people would do mortgage burning book parties. When they sent in their last mortgage payment, they took what was left of that mortgage book and set it on fire, and they were financially free from the man. I look at that as totally wrong. I don't ever want to pay off a mortgage, and I don't ever prepay a mortgage. And I learned this from Rick Edelman. Reason number one was you never pay off a mortgage is it doesn't affect your home's value. A lot of people buy a home because they think it's going to rise in value over time. If you were certain it would fall in value, you probably wouldn't buy it. You'd rent. Your home's value will rise and fall many times over your 30 years, and you just won't see it. Now you can with websites out there like Zillow. You could see how your home's tracked in the last 10 years, but back then you couldn't really find it. It wasn't listed in the newspapers. Your home was an asset that you knew roughly what it was worth. A mortgage won't stop you from building equity in the house. Everyone wants to build equity. That's the goal. It's the main financial reason to owning a house. Mortgages, some people think are bad. Many people say the bigger the mortgage, the lower your equity, but I look at it differently. You know, when you buy a house and you get a mortgage, maybe $1 million house with a $500,000 mortgage, your down payment, that's your starting equity as your down payment. And you're going to build equity over time by sending in your mortgage payment, which is principal and interest. I don't ever prepay. And instead, what I would do with my prepayment, I would invest it in the S&P 500. Because remember how I said in 30-year periods, the stock market beats real estate by over 400%. And if I lost my job and I was prepaying my mortgage, I probably wouldn't have any cash because I'm prepaying the mortgage. So I don't prepay the mortgage, I put it in stocks. And if I lost my job, I could sell my stocks overnight and live off that. So your home's going to go up in value and you're going to slowly build equity. And that's okay as long as you're investing elsewhere. Mortgage is cheap money. It's the cheapest money you'll ever be able to borrow. Even now, when mortgages are 6.5% for a 30-year fixed, go take a look what a credit card statement charges you, or a student loan, or a personal loan, or a car loan. Mortgage rates are typically lower than all of them. Now, one of the mistakes I did make in my lifetime was I bought 3 or 4 homes with 30-year mortgages, and I didn't live in those homes for 30 years. I was just afraid that, after 7 years, what if mortgage rates are super high? I should have done a 7-year ARM on every single one of them and not be afraid. We all make mistakes, and I've done it too. Your mortgage interest is tax deductible. Your mortgage interest is tax favorable. The deduction you are taken on your mortgage interest is taken at the top bracket. So whatever top bracket you're in. Whereas if you save money in S&P 500, your capital gains tax is much lower. So this is where you start thinking about taxes for the first time in your life. Mortgage payments get easier over time. When I was 20 years old, my first mortgage payment was I think $895. And every year after that, my income went up. Now, $895 on my first salary was a lot. I was probably making $40,000. There was a couple years there where I wasn't paying myself. I was living off my savings from investments to start my company. But through the years, my income's gone up, but the mortgage payment stays exactly the same every single payment. It's fixed. Now, a lot of people don't like mortgages because they saw their grandmother and grandfather lose the farm. Mortgages used to be callable, but they're not anymore. When rough times hit, banks said, we want our farm back, or we want our money back. You tell me. But now they can't legally do that. So anyway, it's just a nod to Rick Edelman. It's a nod, quick thank you. I know I say a lot of stuff, and I hope you pass it on to your children. Mortgages are okay. They're a good financial tool. And if you use them wisely and don't prepay them, you're able to invest more money on the side, and that's going to grow faster than the real estate. I love real estate. I love stocks. Not crazy about bonds, but I'm getting there. I prefer dividend income from my stocks versus bonds at this point in time. You can always contact me at robblackshow.com. Go there, sign up for an email list. Drop me an email, rob@robblack.com. I'm Rob Black.
Visit The Rob Black Show online at robblackshow.com. Listen to archived podcasts, market updates, and information from EP Wealth's certified financial planners online at robblackshow.com.